One of the things that has frustrated me as I've been doing commentary for the last, several years, is this idea that we would have all of this intervention in the economy and there would be no repercussions, that there would be, nothing on the other side of that. We would just be able to manage around that. And I think that we're finally starting to see cracks in the story and kind of explain, what has been misinterpreted. I think over the last, or the 15 years that we had, ZIRP or close to ZIRP in the last couple of years, early on, one of the things that was sort of misstated was the idea that even though we had this highly interventionist Fed, that there was no inflation. And I've argued for a long time, I argued it 2 books ago and before that, that wasn't the case, that we had massive inflation. That inflation was in assets, and it was in the stock market, it was in homes. And so the people who had assets and benefited from that kind of loved it and didn't really view it that way. And it wasn't until some of the recent policy, some of the direct stimulus to consumers and some of the other decisions where we saw that inflation migrate just from the asset side to sort of everyday cost of living. And then it's like, oh, look, we have this inflation, which, I would contend has been going on for a long time. So I think that's one thing that we have to kind of look at. The other thing is this idea that we've had this amazing economy. And I really feel like the economy has been very much window dressed, and we're starting to see a little crack in that window dressing. They're starting to run out of decorations, so to speak, Julia. And if you look back at just, let's say last fiscal year, the government ran deficits to GDP that were, depending on, what you count the deficit, I say it was $2 trillion because there was an accounting little trickery that was going on there, but they really spent $2 trillion. So deficits to GDP were like 7+%. And that is, double the historic average. And when you think about going back in history, if you have expansion, that should be reducing the deficit, right? You're collecting more money that's able to pay down the deficits and cover some of the spending. But what they've done is the opposite. They tried to use deficit spending to show that we had this incredible quote unquote economy. And that was incredibly expensive, not just in terms of the dollars of the deficit, but now they have to finance it at the highest rates that we've seen in 15, 17 years. So now that we've got some data points coming out here in 2024, Q1, that 1.6% was almost a full percentage point less than the street expected. We had the April jobs report that was not as robust as expected. I think we're starting to see diminishing returns on all of that excess spending. And I think that really can shine a light for the people who haven't glommed onto this already, that there really hasn't been this amazing economy. It has been a deficit-driven economy, very expensive, and we are paying the price for that quite literally today, and will continue to do so in the future. No, the word sustainable is one that has come up, the opposite of it, non-sustainable, a lot. And you've had pretty much every entity and, high-profile person that exists saying that the fiscal situation of the United States isn't sustainable. It's the IMF. It's the CBO, it's the Treasury, it's the Fed, it's Jamie Dimon, it's Nassim Taleb. Like anyone and everyone has said, you'd have to be kind of crazy to say, no, I think this is entirely sustainable. And we're seeing even just the interest on the debt, the last estimate that I've seen, that is if we don't do anything to interest rates and we don't do anything to change sort of the spending, that we're on track for $1.7 trillion in interest expense over the next 12 months, which puts it potentially as the biggest line item on the federal budget. And so what does that say about a country whose biggest expense is interest on their debt? That is not a healthy situation. That is not a sustainable situation. And so the challenge is there's this giant elephant in the room. We all see it, and nobody is like, hey, maybe we should get the elephant out of the room. And that's the challenge, is that we don't have the political will, and we don't have enough pressure from individuals. That people are freaking out about a lot of things, and there are plenty of things to freak out about. But like like, when's the last time we saw a march in the streets, on the Fed or on the fiscal situation or about the debt? Like, never. So until that becomes an issue that politicians say we can't find a way around anymore, and I don't think anything's going to be done. And we have a large part of the population that's financially illiterate. So it's a huge challenge, and it really is going to change the tenor of what is possible, for us in the future in terms of our wealth, our quality of life, our access to commodities, things just kind of working. And I don't think, particularly, in Wall Street circles where everything is great and people have benefited, I don't think that there's a bit of a full wake-up call in some of those circles. We could have this argument that we probably already are in fiscal dominance, or we're really close to the edge of it. But, for people who don't know what that means, it's exactly what it sounds like, right? It's that the fiscal policy dominates the monetary policy. And I would make that contention right now. I think the Fed is in a giant pickle, is my nicest way I can say it, is that if they were to lower interest rates, I actually think if they lowered it a bit, it really wouldn't do anything. It's not like we're going to have this giant boom if they lowered it 50 basis points. But, over time, as they lower interest rates, we know that can be inflationary. At the same time, if they do nothing or they continue to raise interest rates, then we have all of this interest that we have to pay on our debt, not just the new deficit, the deficit financing, but we have a lot of refinancing that needs to be done on our national debt. And we have been issuing a crazy amount at the front end of the curve because there aren't enough buyers at a reasonable price, for longer duration treasuries. So we have just this massive refinancing that needs to go over and over and over again, and at continually higher rates, and that average goes up. That in and itself is going to end up being inflationary. The Fed, in my opinion, is going to be the only buyer left standing at any interest rate that would be acceptable. And so, yeah, I do think that we are in or near fiscal dominance. And I think that this inflation outlook that we've been talking about, stagflation or whatever it is something that's just going to be with us for a long time, because the federal government is moving in the exact opposite direction that the Fed has been trying to get everybody else to move for several years. So, this is the same Fed that told us that there would be no inflation. Inflation is going to be transitory. There's a path to a soft landing. What are they going to say? I know they're supposed to be quote unquote independent, if anyone believes that. They haven't been forceful enough in putting it to the federal government going, listen, guys, we've run out of tools here. This is all in your corner. You need to do something. That's what I would love to hear from the Fed, but we know we're never going to hear that. What they have done, and they signaled it and they keep kind of pushing it, is saying that, well, we might not be able to do anything with interest rates, but we certainly do have the balance sheet as a tool. And where, we saw that they were, doing some quantitative tightening, they're starting to move away from that. They're gonna take it a little bit easy on that, even more than we had expected and they had telegraphed. So I think that just goes to show you, that they are moving in a more accommodative direction out of need, and trying to do so in a way where people, don't go, well, this is going to create inflation and create that expectation and make that a self-fulfilling prophecy, because most people aren't really paying attention to the Fed in general, but when they do, they certainly aren't paying attention to the balance sheet conversations if they know it. One thing we know, you mentioned Luke Roman, whose research I love and read, and has so many things on my radar. Really appreciate him. One thing that he's put out previously, which he may have discussed with you in his appearance, is just who has been a buyer of the U.S. debt for the last decade. And, we have seen the national debt almost double from, it was about 16 trillion 10 years ago to, the mammoth that is today. And basically, if you look at central banks around the world, they have been over the same period of time net sellers. they're actually down about $100 billion in treasury. So where we used to be able to look to central banks to help us finance our debt, that has really been net off the table in terms of who's been in selling and netting that out over the last 10 years, which means you do have, some foreign buyers, and obviously you have the banks. We know the primary dealers have been getting stuck with more and more of the debt. But, as we look at this, sort of unsustainable picture, we see the Fed doing more, and just the fact that they're not quite letting as much run off the balance sheet, and they are going back and buying a little bit to supplement what's on the balance sheet. I think that just gives you an idea of where their head's at and the reality that they're facing in terms of all of this debt that needs financing, new or existing, and who the buyers are, what the appetite is at any interest rate that would be palatable. The Fed, they have all of these crazy programs and all these things they do and make up to try to be opaque. I think if they don't do something by July, I think it will be very hard for them to do anything. I think they will sit tight, probably, in terms of the election. Just, they may telegraph something a little bit, but I don't think they want to be perceived to be political in either direction. So I do kind of agree with that. But I do think the balance sheet conversation is probably more important, and I would be paying attention to that because, there will be, if data continues to trend in what we're seeing here, it does give them enough cover to say, well, we're going to at least cut a little bit. And again, do you really think, Julia, that if they cut 25 basis points, 50 basis points, even 100, do you think that that's going to unleash the economy in some special way? I don't really see that happening. So I think they have some room. It's not like they're going from 5.25 to 2. If you go from 5.25 to, 4.75, does that really change the dynamic of the economy other than just, creating some optimism for the street? So, I think they have a little bit more room than perhaps, some other people do. I think that there's some data out there. So could they throw a little something out there? It's possible, but they just may really focus on that balance sheet side. And again, both of the tools, are doing the same things. You can be accommodative either way. So that just may be their backdoor way to get this done.